Over the weekend, one of the most prominent Tesla bulls in the world climbed into a Tesla Robotaxi in Austin. No driver, no safety monitor in the car, and then spent the entire ride ignoring it. That same week, Tesla published its first-ever safety numbers for full self-driving on European roads. And the market gets its first chance to react to both at the open. We've also got a fresh caution note from another well-known bull, Waymo buying Apple's abandoned self-driving test track, the Model Y topping the sales charts in a surprising place, and more. This is the Tesla Brief, pre-market on June 9th. Welcome to the show. A quick check on where the stock stands. Tesla closed yesterday at $408.87, and it's essentially flat in early pre-market trade, just above 409. We don't have live index futures this morning, but the Nasdaq closed up 0.9% yesterday, and the S&P 500 up 0.3. So there's no weekend news reaction priced in yet, and that test comes at the open. Let's start with that Robotaxi ride, because two stories landed this week that fit together neatly. The first, Cathie Wood, who runs the investment firm ARK Invest, took her first unsupervised Tesla Robotaxi ride in Austin. No driver, no safety monitor, just the car. Her takeaway, in her own words, the fact that I was talking to you the whole time and didn't pay any attention to the ride itself means that I think it's completely safe. I do think now, this slowly is moving into all at once. Now that's worth sitting with for a second. This is one of the most credible bulls in the world, riding in the actual product with nobody minding the wheel, and her verdict is that it works. That's a very different data point from Tesla's own polished demo footage. But the more interesting detail for investors was small and easy to miss. During the ride, the car picked up a $75 parking ticket. Wood used that to publicly ask Tesla a fair question. How does it plan to handle parking and traffic violations once this is a real commercial fleet? It sounds trivial. It isn't. It points at a whole category of costs the bull case hasn't properly priced yet. Tickets, fines, accident liability, the cost of moving idle cars around to where the demand is. None of that shows up in a demo. All of it shows up in the economics of a real robotaxi business. And that's the through line into the second story. The same week, Tesla's European account published its first ever safety dataset for supervised full self-driving on Dutch roads, covering April 10th to June 5th. The headline number, cars driving with FSD switched on, had 3.5 times fewer collisions than the same cars driven manually by their owners. On highways, the gap was wider still, 16.6 million kilometers driven with 0 collisions, which Tesla translates to 3.4 times safer than a human. The supporting numbers all point the same way. Almost 15 times fewer automatic emergency braking events, nearly 9 times less harsh acceleration, more than 7 times less harsh braking, and 8 times fewer hard swerves. Here's why that matters more than another safety stat. Until now, every safety claim Tesla has made for FSD has been built on US data. And European regulators have been the slowest in the world to approve the system. Publishing actual fleet numbers from inside a European country is the first brick in the regulatory case for unsupervised FSD in Europe. So put the two together. One of the world's best-known bulls is riding the product with no one in the driver's seat and saying it's safe. And Tesla is quietly publishing real-world fleet numbers from Europe. The pattern this week is Tesla trying to move the conversation from trust the demo to look at the numbers. The honest caveat, this is a 2-month window, and it's Tesla's own data, not an independent regulator's audit. It's a strong start to the argument, not the end of it. And yet from the very same weekend, another prominent bull arrived at the opposite conclusion. Gary Black, who runs the Future Fund, put out his pre-market note this morning saying he remains cautious on Tesla, even as the rest of the AI trade bounced for a second day. In his words, I remain cautious on Tesla due to declining estimates, rising autonomy competition, and a stretched valuation. 3 reasons: earnings estimates still being cut, autonomy competition heating up, and a stock that he thinks is expensive for the earnings underneath it. The tension is that the backdrop he describes is actually pretty good. Earnings estimates for the S&P 500 next year just got revised up toward 22% growth. Oil is back down around $93, and Middle East tensions are easing. So the broad market keeps grinding higher, and Black's view is that Tesla specifically gets left behind, because its own numbers are heading the wrong way while everyone else's head the right way. He's also flagging more than $280 billion of AI-related stock being sold into the market as a sign of speculative froth. What's striking is the split. Cathie Wood looks at the autonomy story and says it's moving from slowly to all at once. Gary Black looks at the same autonomy story and lists competition as one of 3 reasons to stay careful. Same product, same week, 2 of the most followed Tesla bulls in the world, opposite reads. We're not here to pick the winner. Both reads are honest, and you weigh them. On that autonomy competition point, there was a concrete development. Waymo bought Apple's old self-driving proving ground in Arizona. 5,500 acres, including a fake city course, a vehicle handling area, a 4-mile oval, and a freeway course. The price was $220 million. Apple originally paid $125 million for it back in 2021. And here's the detail worth holding on to, per TechCrunch. Apple spent roughly 10 years and about $10 billion trying to build a self-driving car before quietly canceling the project in early 2024. That cuts 2 ways for Tesla. On one side, it's a point for the bulls. Apple, with effectively unlimited money, couldn't crack autonomy, which thins out the field of serious players. On the other side, Waymo is now visibly buying the kind of physical testing capacity you build when you intend to scale hard, in many of the same cities Tesla wants to enter with the Cybercab. For the next phase of this, the Robotaxi race is essentially Tesla versus Waymo, and Waymo just added to its toolkit. Switching to the car business, there was a genuinely surprising sales print. In May, the Tesla Model Y was the single best-selling car in South Korea. Not the best-selling import, not the best-selling electric car, the best-selling car of any kind, with 8,762 units, ahead of the Kia Sorento and the Hyundai Grandeur. According to figures that circulated over the weekend, and that Elon Musk amplified, Tesla as a brand sold 10,866 cars in Korea that month, more than BMW and Mercedes combined. Roughly 1 in 3 imported cars sold in Korea this year has been a Tesla. Why that's notable? Korea is the home market of Hyundai and Kia, 2 of Tesla's most aggressive electric car rivals anywhere in the world. The bear case on Tesla's car business this past year has been that Chinese and Korean competition is eating its lunch across Asia. A result like this, from inside Hyundai and Kia's own backyard, cuts directly against that story, at least for 1 month, in one country. It's a single data point from a community source rather than an official tally, so hold it loosely. The things to watch are whether June holds the pattern and whether Hyundai responds with price cuts. Over on the energy side, which is currently Tesla's highest margin and fastest growing business, we got new aerial footage of the Megapack factory going up in Brookshire, Texas, about 40 minutes outside Houston. When it's fully ramped, that plant is meant to produce 50 gigawatt-hours of Megapacks a year and employ up to 1,500 people. To put that in perspective, Tesla's existing Megapack factories in California and China together make about 60 gigawatt-hours a year. So Brookshire on its own would nearly double Tesla's storage battery output. The flyover shows a 600,000 square foot building, foundation work tying it into the larger 1 million square foot main factory, and Megapack shells already staged on site. There's no confirmed start date, but the construction pace looks consistent with a late 2026 or early 2027 ramp. For anyone asking where Tesla Energy's growth comes from once California maxes out, Brookshire is the answer, and now you can watch it being poured in concrete. A few more things to round out the morning. SpaceX released a long interview with Elon Musk, laying out a push into AI satellites, and 3 pieces of it touched Tesla. It announced a new Gigasat factory in Bastrop, Texas, on more than 1,000 acres, making solar cells, wafers, and AI satellites starting end of 2027. Musk described a planned production complex he's calling Terafab at roughly 100 million square feet, about 10 times the size of Tesla's Texas vehicle factory. And most relevant to Tesla's AI story, one of the SpaceX videos appears to show a Tesla-designed AI chip inside the satellite hardware. If that's confirmed, it'd be the first public sign of Tesla's chip program selling into another Musk company at scale. A real sign of what it means for the AI-5 chip. The catch, that identification came from a community account, not from Tesla or SpaceX, so treat it as suggestive, not verified. In other news, Tesla has posted a job ad for a semi-truck sales role based in Parsdorf, just outside Munich. It's straight commercial work, lining up European fleet customers and charging. It's the first concrete operational signal that Tesla is preparing to bring the Semi to Europe, lining up with Musk's comment in February that the Semi would hopefully arrive next year. In the US, the Semi only started high-volume production near Giga, Nevada in late April, targeting 50,000 trucks a year with PepsiCo and Frito-Lay as launch customers. The Semi has been the most delayed product in the lineup, so the hire matters mostly because it turns next year from a comment into a hiring plan, which is the step before a delivery plan. In the investor community, the weekend chatter was the SpaceX IPO. Reports over the weekend suggested the listing is heavily oversubscribed, and that set off some half-joking talk among Tesla retail holders about a possible Tesla-SpaceX merger. To be clear, there's zero official basis for that. Musk hasn't proposed one, and no filing mentions it. What the chatter really signals is the underlying tension. Tesla holders watching SpaceX go public are doing the math. Trim Tesla to fund a SpaceX position, or hold Tesla as the backdoor way to own both. Worth tracking, because if SpaceX trades sharply higher after listing, that pressure on Tesla shareholders gets real fast. And on Optimus, nothing material in the last day. The standing picture, version 3, was originally targeted for around now, then pushed to late 2026. What investors are watching for is a hardware reveal, any hard number on unit cost, and the first real customer pilot beyond Tesla's own factory floor. One thing from the weekend that touches the broader robot story: NVIDIA and Hyundai deepened a partnership to push, in their words, physical AI and robotics into real industrial products. It doesn't compete with Optimus directly yet, but it's a sign more money and more credible players are crowding into the lane Tesla wants to own. Step back, and the theme of the week is clear. Tesla is trying to convert the demo works into the numbers prove it. Cathie Wood riding with nobody at the wheel, the first European fleet safety data, the cybercab edging toward a real commercial service. The question that decides how this plays out isn't whether the cars can drive themselves on a good day. It's whether those fleet numbers translate into regulatory approval for unsupervised driving, and whether the boring unit economics questions, the tickets, the fines, the liability, get real answers. That's what to watch in the weeks ahead. That's the Tesla Brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.